Information Nathan with a non-IT topic to talk about, and that is covered calls. Thanks to my good friend Larry, who taught me about this a long time ago. I have been utilizing this technique to provide a low-risk way to make money in my retirement accounts. The basic idea behind the covered call is that you're going to acquire a stock or an ETF of a given security, and I'll just use the example of Cisco, CSCO. And while you own that, you can then sell a call option to someone else out there. And in this scenario, I'm going to say that I've bought 100 shares of CSCO, of Cisco Systems, and let's say that I bought it at $30 per share. Okay? What I'm going to do is I'm going to, when I'm in my trading software, in my case Scottrade, I go into options and I'm going to do what's called sell to open. And I'm going to select a price. When I do a cover call, I'm always going to select a price that's above what I paid for it. So if I paid $30 a share, I might select the $32 option, and I'm going to generally select it for 1 to 2 or possibly 3 months out from where we are right now. The further out that you go, generally the better premium that you're going to get for it, but that means that you may have to hold on to it for a longer time period, and I'll talk about that a little bit more. But let's just say that it's February now, and I'm going to sell the $32 April call. So I'm going to collect a premium on the sale of this, and I'm going to get that money no matter what happens. I don't know, what I'm selling when I do this is that is giving whoever bought my option, that's giving them the right to purchase my shares of Cisco for $32. Now they could exercise that right away, but it would be kind of foolish to do so because they're at $30 right now. But over time, between now and April, if the shares go up to say $33, well then they got a bargain. They can buy these shares that are worth $33, they can buy them for $32 from me. Now, I'm still going to make money on the deal though, because I only paid $30 for my shares. I'm not going to make as much money as I could if I was just the sort of holding the shares on my own with no option there, but I'm still good because I made money on selling the option itself, and I'm going to make $2 a share on the sale of the stock as well. And these guys are happy because they only paid a small premium, and they're getting to get those shares at a higher value. I like choosing stocks that pay a dividend so that while I'm waiting for this time period to pass, I may hit a period where I actually collect a dividend from the stock. And so that's also increasing my income from holding it. Now, is there some risk associated with this? Absolutely. What if the shares go down? Well, that is entirely possible. And one thing that I do to try to protect myself against that is I try to find things that are fairly stable. That's why my friend likes to use ETFs, because they're extremely stable. They represent a large, swath of the market and not just a single stock. And this same principle applies even if you're going to trade with ETFs. But yes, the shares could go down in price. Let's say that it goes down to $29, right? And so this person is definitely not going, and it comes around to April and the shares have dropped from 30 to 29. Well, this person is certainly not going to exercise that option. It's going to expire on the third week, the third Friday in April. It's going to expire worthless. Nobody's going to want it. But I still made some money here from selling the option, and I may have even made enough money to cover my loss there. So I've got some downside protection. Now, if the stock really tanks, then, well, that is the area where I'm exposed to some risk, but I am kind of hedging my bets here. And once again, that's why it's kind of important to choose something, to choose a stock or an ETF that you don't mind holding on to for a long time. You may want to choose something that you would buy anyway, even if you weren't doing a covered call, and hold on to it. That's the basic concept behind a covered call. I hope that's helpful for you. I'd suggest that you get help from a real certified professional. This is just information, Nathan's opinion, and I'm not a certified financial planner or stockbroker or anything like that, but hopefully it's helpful for you. Thanks, and check out my other videos on YouTube.